Happy morning, happy afternoon, and happy evening to all my Nanbas and Nanbis. I hope all of you are studying in full swing and have given so many resources for strategic management, guys. And one of the videos, one student came and commented, "Ma'am, do you also teach financial management?" Then only I was like, yes, FM is also there. And on the other side, we have the legend, KM Sir. I'm not talking about Karthik Manikonda Sir, guys. Of course, he's also a legend. But Kaushik Mukesh Sir is there with us. And immediately we asked him, Sir, can you give something for our students for FM? And he was like, FM theory is a place where students usually skip and go to the exam. So I will give the FM theory for all the students to get benefited before the examination. And it is also my humble request to not leave anything and go for the exam, guys. This theory is part of your syllabus. It is your duty to know what is there in that. So yes, make use of it and enjoy with Kaushik Mukesh sir. Over to sir.
Hello, all the CA Inter students. Now we are going to make a quick revision of CA Inter FM theory. So in this regard, I am going to first start with our chapter number 1, scope and objectives of financial management, and you can expect a 4 to 5 marks question in coming examinations. So just in a very less span of time, we are going to revise each and every theory question in this particular area in my style. Let's start. See, what is the first question? What are the stages an entrepreneur will go through while starting a business or a venture? Simple logic. Whenever I say business, an entrepreneur will have two important decisions to take. Number one, where to get the money, where to put the money. How to get the money, how to put the money. How much to get the money, how much to put the money. Sir, what are all these? In simple, financing decision, investment decision. Okay. See, I wanted to take a home loan. I wanted to take a home loan. Okay, now tell me, you will take loan and buy the asset, or you will first buy the asset, later take a loan? I will first take a loan and then I will buy an asset. Means first financing, next investment. Correct? Now catch point will come. Listen carefully. Though financing happens first and investment happens second, without investment ideology, financing can't happen. Shall I tell an example? Listen carefully. I went to bank. I said, give me home loan. They said, how much? No, no, give me home loan. Bank said, okay, sir, I will give you how much? Give home loan. Arey Muttal, I will give you how much? No, no, give home loan. Whatever amount you want, you give me. Like that, we can't ask na. Unless and until you have an idea about how much investment, that much of financing only we should make. And then you will make investment. So how it will be? It's a cycle. Investment ideology, financing, investment decision. Investment ideology first. Next, to that extent, finance it. Then make investment directly. Okay, let's understand. If you understand this way, why you will forget FM theory? Like a fools, we are mugging up all the concepts. We don't want logic. That's why question papers are scaring us. See, stage one, decide which assets to buy. First you target. I wanted to buy this. Okay, this cost 1 crore. So take 1 crore loan and then you buy. Decide about investment amount involved. Investment amount involved. Sir, I wanted to buy this building. Okay, stage 1 completed. Stage 2, how much is the cost of this building? That's the second stage. Next, third stage, that much amount first you need to finance. Decide about the capital that is required to run the day-to-day activity, also called as what? Working capital. Decide about the sources of funding, equity, debt, preference. So first these two, next these two. Understand? Stage 1, decide what assets you wanted to buy. Okay. Second, decide about amount involved. That amount we need to get done. How much amount is involved? That is about the capital that is required. Capital that is required. Two types of capital. Decide about amount of investment means this is the main capital required. For to run the business, every day also some capital is required, working capital. Next, from where to get that working capital, from where to get that fixed capital to invest in asset. Decide about the sources of funding, equity, debt, preference, etc. Next, what are the three key questions that are required to be answered in a business with respect to money? With respect to money in a business, there are three questions that are required to be answered. What are those three? From where to get the money? Financing. From where to put the money or where to invest the money? Investment decision. After financing and investing, profits will be made. That is called as a dividend decision. So whether to distribute or not, dividend decision. So FM is concerned all about acquisition of funds, after acquisition allocation in the assets, next after that distribute the dividend. Next one, what are the various sources of procurement of funds? What are the various sources of procurement of funds? Okay, now there are so many ways of procurement. There are so many ways of procurement. First one, equity financing. Equity shares are most reliable source of financing. Most reliable. Why most reliable? They don't leave the company. Even though they leave, another person will come and sit in their place. That's why perpetual succession exists in shares, but not in debentures and preference. Understood the point or not? Advantages. Less risky since repayment is not mandatory. Debentures, if you raise after 10 years, you have to repay. So next one, less risky since the repayment is not mandatory. What do you mean by that? Anyway, like a debenture, like a preference share, I need not repay them after 5 years or 10 years. Buyback is optional. If board wanted, they will do, or else they need not. So repayment is not mandatory. That's why company has no finance burden because of equity. Okay, that's the number one. Number two, shareholders gets the share in the growth of company. Whenever company grow, equity shares also will grow. Whenever company projects are growing, debentures will grow, but hardly they will grow by 1 rupee, 2 rupee, 3 rupee. That too because of RBI interest rates they will change, not because of performance of a company. Because debenture holders will get a fixed interest. Whether company is a failure or a success, they will get a fixed return. So company success and failure don't determine that. RBI interest rates will change the debentures value. So reality like growth enjoyment will be there only for equity. What is the disadvantages of equity? High cost. Because they are taking a risk, there is no return guaranteed for them. When there is high risk, high return they will ask. That's why KE is always higher than all kinds of cost of capitals. No tax benefit. Yes, very important. Dividend is an appropriation out of the profits, not a charge against profit like interest. Next, dilution of ownership. Dilution of ownership. What if I dilute the ownership? Whenever the equity shares are increasing, earnings per share will dilute. More number of people will start deciding the company performance. So that's a good, not a good thing. So advantage, disadvantage. Next, debentures. Debentures is a debt to the company. Company takes loan not from one bank but from public. That's called as a debenture. Advantages. KD is very less, and moreover debenture interest is a tax benefit available, and no dilution of ownership. Simply, what are the disadvantages of equity or the advantages of debt? High cost to low cost, no tax benefit, tax benefit, no dilution, no dilution. That's all. Easy. Disadvantages of debt finance. See, advantage here, disadvantage. Less risky, high risk. Repayment is not mandatory. Repayment of capital is mandatory. Okay, shareholders get growth. Here growth will not come, and interest is mandatory whether profits are there to the company or not. Bank financing. No, sir, I don't want to go for debentures. I don't want to take from 100 persons or 1000 persons. I will take from one person. It's a bank. Commercial banks are of good support to the business entrepreneurs. What are the types of loans banks are giving? Loans. These are called as a term loans. Cash credit. Cash credit. OD balances they tell na, that is the next one. Working capital loans. Working capital loans means you should use only for daily, day-to-day working capital, not for any other purpose. So normal long-term loans, also called as a term loans. Cash credit, OD, both are similar. Okay, both are similar. Day-to-day business. Working capital is also similar. So all these three are similar with minor changes. Those anyway not applicable for your exam. I don't want to waste time. So just remember loans, cash credit, OD balances, working capital loans. Next, directly international financing. Sir, India is not a platform for me. Okay, I will go directly to the other part of the world and I will take financing. Yes, you can go. Enterprises need not depend only on domestic funding. They can also go for international markets. Most popular, foreign direct investment, foreign institutional investor, American depository receipts, global depository receipts. Angel financing. Angel financing. See, I will give you an example of what is the angel financing. Who is the angel here? Not like what you are thinking in your mind. Is FF. So let us try to understand who is an angel here. Angel is an individual investor. Angel is a individual investor. Wealthy individual. Wealthy. Huge crores of money like Mukesh Ambani, etc. He is not doing that. Example I am telling. Wealthy individuals. Okay. Why people go for angel financing? Because banks are not giving them loans because they are very new into the market. See, I started my company yesterday. I went for bank loan today. Banks won't give me the loan because I don't have any past track record. But I am a very good person. I came from IAMs. I am a chartered example. I am a chartered accountant. This example actually. So I am a chartered accountant. I am a qualified company secretary. I am a qualified cost accountant. I have a huge what to say background of financing everything, and I am trustworthy. You can believe. So I wanted to start a business. Give the loan. Bank will tell, sir, you are a good person. You are a gentleman. Nice. Everything is good. But how can I believe you? I don't know your past track record of performance, na? So therefore, we can't give you loan. Sorry. I went to a venture capital. Venture capital means small amounts they will give. But I want a minimum 10 crore. That means I am not so small like taking money from private lenders. I am not so big like going for a bank loan. Banks not giving the loan. VCF can't give the loan. In these two cases, in middle, there is one angel called as who came like a god. That's why they call angel financing. Angel finance is a equity finance. That's a very, very important MCQ. It's not a debt finance. Angel financing is equity finance. They wanted to enjoy the growth in future. Angel investors are wealthy individuals investing in startups and expansion. They usually invest between 25 to 60%. They will only give the money. Angel financing is the last option where the company does not qualify for bank loan or too small for venture capital funding. Next one. What are the aspects to be considered for effective utilization of funds? For effective utilization of funds. Okay, let's see. So what are the aspects to be considered for effective utilization? Effective utilization, it's not utilization. Effective utilization means optimum utilization of assets. How to know? Capital budgeting. Capital budgeting, there are some techniques like capital rationing. Means what? I have limited capital of 100 rupees, but the assets available for investment are 150. There are 4 or 5 combination of assets. You have to invest in such assets, your 100 rupees in such a way, overall NPV should be higher. Okay, not just like I have 100 rupees in my pocket, there are 5 assets, total all the cost of 5 assets, invest. No, capital rationing technique you have to apply, and then you have to invest in the assets. Then I call it you are investing in the fixed assets at their optimum level. So the funds should be invested and utilized in such a way that it should utilize the fixed assets at optimum level. Next, long-term investment decision means just because of the reason that you have money today, you should not go on investing in assets unnecessarily. For example, there is a machine which is having a capacity to produce 1 lakh units in a year. 1 lakh units in a year. So my target is to produce 2 lakh units. What you have to do? 2 machines you have to purchase. Correct? Now what I am doing is I have totally 2 lakh capacity. Now what I will do? I will purchase 4 machinery and I will use for 50,000, 50,000, 50,000, 50,000, 2 lakh units I will produce. Is right? 100% wrong, because your more finance is invested in 4 assets, though 2 assets can do the same thing. So long-term investment decision should not endanger, means create a problem of your solvency. Company should not become insolvent after investing in the assets. Next one. For taking these kind of decisions, finance manager should possess knowledge in capital budgeting. Next, capital budgeting, what you will do? You will put your money in long-term assets. Sir, long-term assets, okay. I wanted to produce sugarcane juice. So sugarcane machine is required. That decision taken. But I have to buy sugarcane. I have to buy one person to work on that. Okay. So glass I have to buy. Ice I have to buy. All those will be used every day. I call it working capital. Finance manager should not only have a knowledge on the fixed capital called as a long term, also he should have knowledge on adequate working capital required. More sugarcane purchase. Daily consumption is 1000 glasses of sugarcane juice. For that I require 500 sugarcane. I purchased 10,000. Stock will be useless. I purchased only 30. You can't cater the needs. Adequate amount of working capital only you should invest. He must also ensure that excess working capital is not blocked in the form of inventory, debtors, cash, etc. Next one. You can pause the video and listen to the concept if you want, or you can pause the video and see the document if you want. Okay, I'm first going through entire thing for your exam point of view. Mention the phases in the evolution of FM. Phase 1, traditional phase. And in 1920s, 1910, 20, 30 time, financial management is some alien subject. Normal person should not use it. It will be used in occasional events like takeovers, mergers, acquisitions, liquidation. At that time people use it to have knowledge of financial management. Normal time of finance has no relevance at that time. Okay. FM is considered by investment bankers, lenders and some external persons, means like chartered accountants, normal person, you and me. Normally financial management is not used in traditional phase. Next, transition. Slowly change is happening. At the time of making the change, day-to-day problems of finance managers are also considered. Means along with these big decision like takeovers, mergers, expansion, liquidation, along with that, slowly day-to-day problems of finance managers, not day-to-day problems of a normal household. Company big position of finance managers will be there. For them, they started doing ratio analysis, fund flow statement, so financial planning, fund flow analysis, etc. These used to be done through FM. Okay. Modern phase today, everywhere it is still going on. Modern phase is still going on. Another 100 years it will be. So scope of finance managers and FM is greatly increased. FM started helping in every financial analysis of a company. Okay. Even a small person also can do now. So FM theories that are developed during this phase, efficient market theory, CA final it will come, means whether markets are efficient or inefficient will be dependent on the candlesticks. We are not here to learn that now. So efficient market theory, capital budgeting, option valuation, CA final. So just read and leave these three words. You have to write in exam. Now time is not there. Capital budgeting na chapter is there, I said already. Option valuation means CA final of futures and options chapter is there. Derivatives, there we will see. Efficient market, CA final, security analysis chapter. So modern phase is still going on. Scope of finance managers and financial management is greatly increased during this phase. It started helping every financial analysis of a company. Example, efficient market theory, capital budgeting and options valuation. Next, tasks that are involved in financial management. Okay, easy way I will tell you. Same again, where to put the money, where to get the money, all these things are there na? Same. First, taking care as not to over invest in fixed assets, because it will lead to financial insolvency. So invest in fixed assets, not over invest. I told na, 1 lakh units can be produced by one machine. My target is to produce 2 lakh units. What you have to do? Invest in 2 assets. Instead of doing this, I purchased 4 assets A, B, C, D. Each one will be producing only 50,000. What is this nonsense? Unnecessarily you are over investing in the assets. Next, along with the fixed assets, working capital also is required or not? Sufficient level of working capital, that is current assets. So first point, not to over invest in fixed assets, not to over invest in current assets. Sorry, I kept in fixed assets, I kept in current assets. Current assets will go into fixed assets. Sugarcane will go into sugarcane machine. What will come out? Sugarcane juice. I will sell that. What will come? Inflow. So cash inflows and cash outflow. Next, sir, cash inflow, cash outflow came. At the end, what will be there? Gross profit with a correct pricing you need to do. Finally, tax planning. More debt, more tax saving. Less debt, less tax saving. That's it. 5 points. What you have to write in exam? Tasks involved in FM if they ask. What you have to write? Not to over invest in fixed assets, sufficient investment in current assets. After that, analysis ensuring the proper inflows and outflows, and having a proper gross profit with a proper pricing of the product, and finally tax planning to reduce the tax burden. Read this concept. Pause the video, read this. The next concept. One most important concept in the exam, so many times tested, agency problem and agency cost. Dead easy, listen carefully. What is this agency concept? See, agency means someone acting on behalf of another. See, there is a sole proprietor concern. Okay, what will happen in a sole proprietor concern? The person who invested, owner, will only manage the business. Partnership business, what people will do in a partnership also, partners who invested money, who are the owners, will only manage the partnership firm. This is point 1. Point 2, but in case of a company, there is a separate person who will do that. Those people are called as the managers. Simply board of directors, management. Okay. So management will be the agents to the company. Management will be agents to the company. Company is an artificial person. It cannot do anything on its own. Who should do on behalf of company? These managers has to do everything on behalf of company. Therefore, management will be doing things on behalf of the company. Therefore, management will become the agents to the company. Point number one. Now the agency problem started. What do you mean by agency problem? In a company, owners who invested money, so-called shareholders, do not participate in the management. Then who will participate in management? Board of directors, also called as the managers, will participate. Here there comes a problem called as the agency problem. Okay. Generally, managers or management should always keep company objectives as their objective. Means what? Company goals, company aim, company focus, company objective should become their main priority. But sometimes managers will not do that way. They are human beings. They will always put their personal goals ahead of the company goals. That kind of problem is called as a agency problem. Agency problem. Because of this agency problem, company may always incur a loss also. To counter that agency problem, shareholders have to take some what to say, counter measures. Okay, for that they need to spend some money. So the cost you are spending to tackle the agency problem is called as a agency cost. Is called as agency cost. Let us understand what is this agency cost. Before that, fatafat, let us read the basics. You have to write as it is in exam. In case of sole proprietor and partnership firm, owners usually participate in the management. Point one, that's what I said. Na? Next. But in case of companies, corporates, owners do not participate, managers do that. Management means board of directors. In corporate, there is a separation of ownership and management. Okay. But in reality, and next, managers are actually expected to work in the best interest of the shareholders. But in reality, managers may put their personal goals ahead of the goals of the owners. This problem is called as a agency problem. To tackle this, shareholders have to incur some cost called as agency cost. As it is what I said, line by line they have given as an answer. 4 costs are there. I will call it boss M. What is this boss M? Bonding cost. Bonding cost means what? Consistently conducting meetings with the board of directors, creating a bonding between shareholders and board of directors, saying that we are both our friends. Please don't do any malpractice. Do anything for our benefit. That is bonding cost. But to conduct the meetings, general meetings or board meetings, etc., lot of costs are involved. Those are bonding costs. Number 2, opportunity cost. Suddenly, if any manager is removed and he left, until and unless I fill that place, there will be a management problem or not. That cost I incur is an opportunity cost. Structuring cost means what? I have to remove you if you do wrong. I have to put another person. Structure of the board of directors will change. Na? I have to give training to that fellow. He has to understand. It takes time. Structuring costs are involved. Audit committee will be there. Which committee? Audit committee. That audit committee will monitor whether board of directors are really acting for their benefit or for shareholders' benefit. For that audit committee, I need to pay sitting fees, salaries, etc. Monitoring cost. So what are the costs involved? Boss M. Bonding cost, opportunity cost, structuring cost, and finally monitoring cost. Next, addressing the agency problem. Addressing the agency problem. Okay. Debt lender's point of view. A person has given debt. A person has given debt. How he can tackle this agency problem? See, always board of directors should actually, okay, board of directors. See, what do you mean by debt lender's point of view? When money is given by the lenders, na, if it is misused by the board of directors, then who will suffer? If the company becomes insolvent, they only suffer, na. That's why in the terms and conditions, they call covenant. Covenant means the terms and conditions, agreements. When loan is given by the debt holders to the company, company will not use it. Company is an artificial person. These managers will use. Therefore, they will put negative terms and conditions. If company is not using it in a proper way, we will put one person as a board of director. He will monitor your company. Like that, you can threaten the board of directors. Second, how shareholders can tackle? See, by monitoring the managers. How you can put the managerial remuneration. Compensation means remuneration. You will tell to the board of directors, salary will be given only if you bring this much of profit. Means what? More salary, more profit, more salary. For that they will work. Like that they can do. Or you should clearly tell them our intention is maximize the value of shareholders' stocks. Market shares price should grow. In such a way you do your work. You should motivate them always. Employees should be designed to understand Means from the very beginning, from a low cadre employee to the high end, everyone's focus is only one thing. Share price have to increase. When share price will increase? If sales increase. When sales will increase? If you perform well at an employee level, everything will go right. So that's the point. And effective monitoring. Next, financial management versus financial accounting. So let us understand what is the financial management and financial accounting. Accounting subject you see is a financial accounting. Whatever the subject you are reading here is a financial management. What is the difference between both of them? Seriously, listen carefully. Important question again. Sir, there are totally 11 questions in this chapter. 11 like any one question will come for 4 marks to 5 marks in exam. Again, don't break them into important, unimportant slots. Okay, everything is important. Asla important, unimportant, expected questions, allergy and spoiled your law subject totally. So don't encourage expected questions. If expected questions, even if I say that, sir, please don't tell any expected questions, explain every provision. When we don't know to how to explain any provision or anything or any subject or any concept, then only we will go by expected questions. Wherever I am comfortable, I will give them as expected questions and I will teach them. Please do not go by that. Ask everyone to teach everything, or else don't teach. That's it, as simple as that. Clear? So everything is important. Number of attempts are going, number of new questions are coming. Still students are asking, give important questions, give expected questions. You are writing a professional exam. Okay, point number 1. You have to read everything. Point number 2, please don't ask expected questions to me. Point number 3, you go somewhere and check for expected questions. Those will not come, exam gone. So please do everything. Okay, do everything. Then definitely you will qualify in the examination. Okay. But no, sir, expected questions only I want. I don't want any other thing. Then close the video, happily go to other channel and listen. Okay. I am not the person to give those things. Expected questions, all those. With me, it won't happen. Okay. I will not give you because they don't come anyway. Okay. I will give entire chapter. Prepare capital busting, one question will come. Capital busting really will come in exam. See, I said na capital busting. Like that I have to tell. Why all this dandora unnecessarily? So please listen carefully. Read everything. What is the difference between financial management versus financial accounting? Listen, financial accounting stops and financial management starts. Means what? Financial accounting is the input for financial management. Okay. Financial accounting considers the operational events of a company. Okay. Purchase, sale, gross profit, payments, all these it will consider. Output of financial accounting. What is the output of financial accounting? Balance sheet to profit and loss account and cash flow statement. All these are outputs of financial accounting. Using that balance sheet P&L, financial management, we will analyze our ratios. So financial management analyzes past and take future decisions. FM is all about what? Taking the past into consideration and analyze the future. Next. Treatment of funds. Okay. Financial accounting follow accrual basis. Means what? If something falls under that particular period, all we will consider, even though not paid. If something is receivable during that particular period, we will consider all, though not received. Classic example, prepaid expenses or outstanding expenses. Means what? Rent 11 months paid, 1 month not paid. Even then we will put it in P&L because that rent belongs to that year. Whether or not we pay, we will consider. Understood? Next. So revenues are recognized when the sale is made, not when the amount is actually received. Okay. Credit sales, we will record actually money received. No, but we will write because we follow accrual. Expenses are recognized when they are incurred, not when they are actually paid. Okay. Now, so incomes are recognized when the sale happened. Expenses are recognized when the expenses are incurred, not when they are paid. Next one. Though the books show a profits, company may not have enough liquidity to pay its obligation. This may be because sales are on credit and amount is blocked in collectible receivables. Common sense. 100 times I might have told this in the regular FM batch. What I used to tell, sale happens, profit will come. But profit is only a number in a P&L account. Profit is not cash because I made purchases for 100 rupee. I sold it for 150. Profit is 50. I purchased for 100. I sold for 150. Complete 150 credit sale. Profit is 50. But how much cash profit? 0. You did not realize it because it's a credit sale. Cash is not yet received. So though books show profits, company may not have liquidity because money is blocked in receivables, not collected, collectible. We didn't collect it. On the other hand, FM follow cash basis. That's why FM will always we use cash flow, not profit. Even profits are given, we will add back depreciation and other circus feeds we will do and again bring back to the cash flow. Hence, revenue is recognized only when it is actually received. That's why we call cash inflow. And expenses are recognized only when they are actually paid. That's why we call it cash outflow. Therefore, finance manager focuses is to maintain proper liquidity and not to project profits. So, finance intention is to maintain liquidity. Cash should be there, not to project the profits. Decision making. Financial accounting is collecting and presenting the data, while financial management is targeting on planning, controlling, and decision making. Accounts, so no one can take any decision. FM, the people can make decisions. Next one. Before we read 9th and 10th, I will first discuss about 11th, expected question for September exam. Okay, expected. Why? Because I saw in one of the MTP. That's why. Not because I am expecting. Okay, MTP came, chance is there, it can come. That's all. That does not mean if expected questions I have to tell what I should tell, only this question I should tell. But what I am doing, I am completing entire chapter and lastly saying what is this importance of this question. It came in one of the recent MTP. Chance is there, it can come. Okay, let's see. Role of a finance executive. So CFO. What a CFO has to do? Financial analysis and planning and ratios analysis. Investment decision, capital budgeting. Finance and capital structure chapter. Financial resources management and risk management. So how many are there totally? He has to do 5 different kinds of responsibility. How many? 5 different kinds of responsibility. Okay, what are those? First one, financial analysis and planning, investment decisions, financing and capital structure decision, management of financial resources, means how much to invest, etc. Risk management. Next, role of finance executive comparison and a CFO. What CFO once upon a time used to do, what CFAs are now doing in the world, let us see. Previously, they used to do budgeting. Now also they are doing budgeting work. Forecasting they are also doing now. Accounting, they are no more doing accounting. They are doing management of mergers, acquisitions, big things. This one and this one, previously finance manager used to do. Now accounts department is there to do these both. Accounting and preparation of financial statement. But now they are doing pricing analysis. Previously, finance manager used to do filing of document. They are not doing filing. They are doing decision making now. Okay. Mark this question most important for September exam. Just a direct question will come. Final touch. Profit maximization, wealth maximization. 9 and 10 combinedly we can read and complete. Okay. Let's begin. So see, concept of profit maximization. Okay. Profit, you know, P&L, last element is called as a profit. Originally, more profit, more good the company is. That is the objective of financial management. Traditionally, the primary objective of the business is to earn profit. Hence, it is the objective of financial management. Okay. Hence, financial management has to take such kind of decisions which will maximize the profit. So, how to maximize profit? More sales. That's all. The creditor, cash, they don't see. Okay, give everything on credit. People will buy. Profits will maximize, but cash recovery will be very less. Companies in a liquidity trouble, but they don't want that. Profits has to maximize. Don't put depreciation in P&L account. That's all. Profits will gain. But showing depreciation is right because tax saving will come. So therefore, profit maximization, when it is a motive, financial frauds also will happen. Accounting frauds will happen because their intention was to show more profits. So, however, profit maximization cannot be the sole objective. If then problems will arise. So, problems due to profit maximization objective. So, what problems company will face if profit maximization is your objective? Number one, the term profit is vague. There is no meaning because for me, one amount is a profit. For you, another profit will come because profits are calculated on the basis of accounting assumptions. Means accounting policies. Means I will explain. If I use a FIFO in stock, closing stock, opening stock, one value will come. LIFO, one value will come. Weighted average, one value will come. Bad debts, I assumed a percentage of 5% bad debts. You assume 6%, one person assumed only 2%. Depreciation, life, I assume 10 years, you assume 7 years, another person assume 15 years. For all of us, depreciation is not same. So, accounting is dependent on so many estimates, policies, assumptions, etc. because of which profit will have different meaning for different people. Next, profit maximization objective has a lot of risk involved. Okay, because more profits, more risk. Higher the profits, higher the probability of risk. If profit maximization is the only goal, then risk factor will also be ignored because it will increase. Next, profit maximization objective does not take into account the time patterns, means time value of money is never considered in profit. Never considered in profit. Cash flows consider time value of money. See, there are two projects, project A, project B. Project A, cash flow of 1 crore for 10 years. Cash flow of 1 crore for 10 years. Profit of 20 crore after 10 years. After 10 years. So what they will do, I will get 20 crore after 10 years. Here I will get 1 crore cash flow after 10 years. They will select this, they will reject this. Why? Because 20 crore, 1 crore. But this 20 crore is the profit. Is the profit. You have to reduce you have to deconsider the depreciation. You have to consider a lot of assumptions, everything. Okay. Then after 10 years, you are going to receive it. This 1 crore, 1 crore, 1 crore, 1 crore for 10 years I will receive. Okay, what you will see 1 crore, 1 crore, 1 crore, 1 crore, 1, 1, 1, 1, 1, 10 times 10 crore. Okay, but here 20 crore. So 10 crore, 20 crore. Immediately, what is your intention? 20 crore is bigger than 10 crore. No, but this 20 crore I will not receive today. I will receive after 10 years. For that present value, if you consider, it will be somewhere around 7, 8 lakhs, 7, 8 crores only. But here every year I am getting 1 crore. Sometimes project A might also be better than project B. So do not consider always profits, go by cash flows. So what you need to write in exam, this underlined content is there. Na? The term profit is vague. Profit maximization will have a lot of risk involved. Okay, it does not take into account the time patterns. Profit maximization objective is too narrow objective. It fails to consider workers, consumers, society, and ethical trade back. Profit, profit, profit. That's all. Okay. Next. Wealth maximization. Sir, what is wealth? Wealth is not about profit. Wealth is about the share value in the market. Overall value of the company depends on what? Not on profit. For example, there is a managing director. There is a managing director. He got arrested. He got arrested. Is there anything to do with P&L account? No. But share prices will fall. So you should appoint such kind of MD who is ethical and having a proven standing in the society. Now, share prices are coming down because of P&L account, because of profits. No. And moreover, you should understand another point. Profits are calculated once at the end of year, 31st March. But wealth, every day we have to take care. So therefore, try to understand wealth is dependent on so many factors. One of the factor is profit, but many other factors also will influence. So shareholder value means the market value is created by considering cost benefit analysis adjusted to TVM, simply NPV, present value of benefits, present value of costs. Benefits should be measured in cash flows, not in terms of profits. Shareholders' wealth is maximized only if finance manager takes such decisions which increases the market price of the shares. Take such a kind of decision which increases market price, not increasing profits. Okay, sometimes non-financing decisions also will raise the share price. Okay, for example, company is there, non-financing decision taken, they replaced one MD, share price will rise immediately. Good managing director came. Take such kind of decisions. To maximize the shareholders' wealth, finance manager should consider the following: cash flow, not the profit, cost benefit analysis, and time value of money. Read these concepts carefully. You will definitely get a 4 to 5 marks question. You will do your best. Okay. Thank you very much. We'll meet in the next video relating to one of the another chapter, sources of finance. In that selectively 6-7 questions also we can read. First concentrate on this, a 5 marks chapter. So very good morning all the CA Inter students. I think you are fueling up your preparation. So I'm going to now cover very quickly one theory chapter called as types of financing. There is a huge request from the students regarding this particular area. So I'm covering this, and already in the yesterday's session, I have already uploaded in 30 minutes the complete theory of unit number 1. Definitely question will come in examination for 4 marks. And many people are asking about the PDF. So I'm pinning the PDF in my Telegram group. Telegram group details will be there in the description box below the video. So join there. So many notes are going to come in the next 10-15 days. So you can get the best out of it. Unique materials we are going to release. So join the Telegram channel. You will be updated with all kinds of details regarding the documents as well as for the class. Anyway, let us first start with unit number 2, types of financing. Okay, first one, explain the importance of trade credit and accruals as a source of working capital. What is the cost of these sources? So what is the concept? Listen carefully. See, trade credit is a concept where, see, first point is very clear here. Trade credit or accruals, both are having same meaning. Trade credit or accruals is a greatest source of working capital. Okay, number one, it is a greatest source of working capital. It is a short-term source of finance. Number two, you have to write in exam. Number one, it is a source of working capital. It is a short-term finance. Give one example. I will give two examples. Suppliers giving us a credit of goods. Suppliers giving us credit of goods. We purchased 1 lakh worth goods. Okay. Supplier has given a 3 months credit. Now what does it mean? Supplier has given the goods first. Payment we can make later. Means we can circulate these goods. We can sell them. We will make money. But we will pay them only after 3 months. Clear? So we are using their goods and making our money. This is called as a concept of trade credit. Trade credit means credit sales made by us. Okay. So listen, or credit purchases made by us. Listen carefully. So it refers to credit facility given by supplier of the goods. We purchased on credit. They have given on credit in the normal course of trade. 3 points completed. Point number 1. Yes. Trade credit and accruals are source of working capital. It is a short-term source of finance. It is nothing but credit facility given by suppliers of the goods in normal course of trade. Clear? Sir, who will be dependent on working capital or trade credits? Small scale industry. See, large scale industries, okay, when they are having 10,000 crores, payment of just 5-6 crores to a normal supplier is not a big deal for them. They will just throw that. Clear? For whom it will become a problem? Small scale industry firms are heavily dependent on working capital needs. Okay. Next. Sir, why working capital? Working capital is easy availability, flexibility, and there are no great procedures. Easy availability, flexibility, no great procedures. That's called as informality. Sir, explain this meaning. Listen. I purchased goods on credit for 3 months. Okay. Means what? My pocket is free now. I am not going to pay anything today. 3 months after I will pay. Okay. I will take goods on credit and I will pay later. Same situation. Let's reverse now. I went to a bank. I asked for a bank loan of 3 months. They will eat my brain now. They will ask a PAN card, Aadhaar card, that card, this card, approvals, sanctions, documentation, stamp paper, security, more nonsense. All these formal documentation can be escaped through this working capital. So 4 points we have written now. First, yes, trade credit and accruals is a source of working capital. It is a short-term source of finance. It is a credit given by the suppliers of the goods in the ordinary course of business. Okay, mostly small scale industries are heavily dependent on financing through working capital. It is easy available, flexible, and informal. Over. Next question. What is the cost of these sources? Listen, when I say cost, from the person giving credit, from his point of view, you should see. Supplier key, generally what people will think, you supplied goods, sale completed for you. Correct or not? You supplied goods, sale completed for you. That's a game over. No. Supplier will supply the goods today, but he will receive money after 3 months. There is an opportunity cost or opportunity loss of interest or not. Just before debtors management chapter I uploaded, in that what we learned, we have done 8-9 problems in that. All problems, the common agenda is very simple. Whenever you give credit, there are advantages and disadvantages as well. Advantages, sales will get boosted. Disadvantages are loss of interest. Second one, collection cost will increase, bad debts will increase. Those are all the costs incurred by the supplier of goods on credit. So there can be an argument that trade credit is free. No, but it is not. It involves implicit cost. Though interest may not be charged, there is a cost to that fellow or not. So how the person will tackle? Number one, he will increase the cost of the goods and give on credit to cover that loss of interest, or he will offer cash discount and ask them to pay early. So supplier extending trade credit incur cost in the form of opportunity cost of funds invested in trade receivables. Generally, supplier passes this cost by increasing the price or by not extending cash discount facility. Okay. So if you give cash discount facility, immediately he will ask. Or if you are, he will completely don't give any kind of cash discount such that he will receive full amount. Okay. Very, very important first question. Next one. What do you understand by spontaneous sources of finance? Spontaneous sources of finance means nothing but the previous question. Spontaneous source means you need not go and buy that. You need not go and buy that. By normal course of business, it will get generated. See, I will go to a shop, take a credit card, swipe the credit card, purchase the goods. What happened? Spontaneous source is created. Why? I did not pay, but goods are created without any documentation procedures. Spontaneously it is created. That's called as working capital loan. It refers to financing that arises out of regular day-to-day operation. Spontaneous sources of financing includes all the sources that are available on demand or naturally arise as a part of business. Naturally arise as a part of business. Okay. Trade, credit, accounts payable, etc. Next. Important I will be covering. Explain the term ploughing back of profits. Explain the term ploughing back of profits. Sir, what is this? See, what is ploughing back of profit? Name clear. Plough back the profits. Whenever we wanted to invest in a project, always don't go for bank loan, equity shareholders, a new issue, etc. Profits are there, na? Retained earnings are there, na? Plough them back. Ploughing back means taking the reserves and surplus and investing in the same business. Because of doing this, there is a great advantage. Do you know? Do you know what is the greatest advantage? Listen. Balance sheet la equity share capital reserves and surplus is there. Reserves and surplus are generally idle cash. Correct? When you invest this in the assets of the company, it will generate a return called as R. It will generate a return called as R. Okay. And you are retaining and investing na B into R, it gives the growth. Always listen carefully. Putting the reserves idle is of zero importance. But when those reserves are reinvested somewhere, it will generate growth. It will generate growth. So net worth will increase. What will increase? Net worth will increase. Long-term funds may be provided by accumulating the profits of the company and ploughing them back. So accumulated profits means reserves will be ploughed back. Ploughing means from digging from the down. Such funds belong to the shareholders. Obvious. Increase the net worth because there is a growth. Public limited company must plough back reasonable amount of profits each year. So you can plough back public limited companies, but reserves and surplus always you cannot draw back. There are certain conditions that were given in Companies Act because reserves and surplus is nothing but, I repeat, reserves and surplus is nothing but the profits belonging to the equity shareholders. Correct? Therefore, Companies Act you have to comply and do that. Next, such funds also entail almost no risk. So risk will not be there because it is not any fund that is to be taken and paid back. It is equity shareholders money only. Yesterday what we discussed, equity shareholders money is safe. Why it is safe? Because we will take but we need not give back. Same here also. Further, control of the present owners is also not diluted by retaining the profits. Okay, because previously your money is in this pocket. Now this pocket I took money and I invested in this pocket in the form of assets. Means your money is not wasted. Previously your money is in reserves and surplus idle. Now it is invested in assets. Again that will generate profits. So that's the point. Read this very important. Wherever some sort of great importance is there, I will only tell you. Next one. Advantages of raising funds by equity shareholder, equity issue. Yesterday only we read na. Same questions are there in unit number 1 also. So first one. Equity shares is a permanent source, means we need not repay back. That's what we call not redeemable. Okay, next. No liability of cash outflow. Equity capital increases company's financial base. Okay, and helps to increase borrowing power. Sir, why equity share capital will increase my borrowing power? Listen carefully. Debt equity ratio is 2:1. Means if equity is 100, debt can be 200. If equity is 200, debt can be 400. Means the borrowing power is dependent on the equity you are holding. That's what you wanted to tell. So permanent source of finance, not redeemable. It will increase the overall finance base. Borrowing powers will increase. Next, company is not obliged, means no obligation legally to pay the dividend. So dividend payment is not mandatory. If you have, you can pay the dividend. Dividend payments can be reduced. Last year 12, this year you can pay 10 also, or you can pay again 12, same even, or you can either be suspended also. Okay, next, issue can be made also through rights. Financing a business through borrowing is cheaper than equity. Briefly explain. Okay, briefly explain. So what he is asking, borrowing is cheaper than equity is a question he is asking. Shall we start? Capital structure theories already we will discuss about this in depth for 1 hour. Okay, let's see. First thing, yes, true. Financing a business through borrowing cheaper than using equity, 100%. Why borrowing is always cheaper? Number one, borrowings whenever you make, you will pay a fixed return to them. So there is no risk to them. When risk is less, return is less. Reason number one. So obviously they will ask a lesser return. Okay, debt capital is cheaper than equity capital from the point of view of cost. One point I said now. KD will always be lesser than KE because KE they will be getting a variable return, high risk, high return. Debt compulsory you will get 100, 100, 100, 100, 100 for next 5 years. Where is the risk here? No risk. No risk. Some return will be given. Low risk low return will be coming. So return paid to debt is low. Cost of the company also low. Number one. Okay. Next advantage of debt. Interest is tax deductible. Interest is tax deductible. But dividends, no such deduction is allowed. Next. Issue of new equity dilutes the ownership. But borrowing do not dilute the ownership. Does not result in dilution. Next one. See, when the sale prices are increasing, sales will increase, contribution increase, EBIT increase, but interest cost will be same. So when the prices of the product is increasing, that if the company is financed more by debt, you will be in a more safe position because for the increased sale also, you have to pay the same fixed cost. So in a period of rising prices, sale prices, borrowing is advantageous. The fixed monetary outgo decreases in real terms as the price level increases. As the selling price increases, automatically in real terms, if you see here, 1000 units I manufactured, fixed cost is 10,000. I produced 1200 units. Even though fixed cost is how much? 10,000. But if you observe in real terms means per unit terms. Here it is 10 rupee. Here it is 8.33 only. Means in real terms, fixed cost is reducing or not? Okay. So fixed monetary outgo decreases as the price level increases. As the selling price is increases, fixed cost overall will be same. But in real terms, if you see, per unit price is slowly coming down. Read the 3 points. Next, preference shares as an instrument of raising funds. Sir, preference share is not completely debt, not completely equity, middle of both. So what is the advantage of issuing preference shares? No dilution of EPS on enlarged capital base. No dilution of EPS. Okay, on enlarged capital base, because preference dividend is not deducted. Preference dividend is not deducted and calculated EPS. EPS is calculated after profit after tax. Okay, from that two people will take equity, preference. Are you understanding? Okay. There is no risk of takeover as the preference shareholders do not have voting rights. They will not be given any kind of voting. Therefore, you need not worry about control shifting to other person. Next, there is leveraging advantage. Why leverage will come? Whenever there is a fixed cost, leverage will come. So, since there is a fixed charge, preference dividends are fixed and pre-decided. Preference shareholders do not participate in surplus profit like a original shareholder. Advantage is no need to pay anything extra. They will take only fixed percentage. Preference share capital can be redeemed. They will not stay in your company permanently. Next, list out the conditions framed by SEBI which a company need to fulfill in order to issue bonus shares. Companies Act concept, yeah. Bonus shares can be issued by free reserve, securities minimum, capital redemption reserve, balance in P&L account or sinking fund. This you need not write. This 4 you have to write. Free reserve, securities minimum, capital redemption reserve, and balance in P&L account. Okay, done. Next, debt securitization. So debt securitization means whenever any loan taken from bank is NPA, non-performing asset. Companies don't have time to take care of those idiots. Therefore, those idiots are sold to another person. That person is expert in collecting money by doing lot of rowdyism. Those persons we call securitization companies. Securitization companies. See, debt securitization, market important. This examiner they can ask. Okay. It is a method of recycling of funds. It is especially beneficial to financial intermediaries to support the lending volumes. Okay. Assets generating steady cash flows are packed together against this asset pool. Market securities can be issued: housing finance, auto loans, credit card receivables, etc. Okay. So, what is the idea behind? Listen carefully. In simple terms, I will tell you. See here. Securitization, these are the parties involved. Okay. First, banks will give loans. Please listen, I will repeat only once. Only once. If you don't listen, I'm not responsible for that. Okay. Banks will give loans to institutions and individuals. Once bank give loans, what will happen? Money goes out of the bank hand at once. But bank will collect back that money in the form of EMIs. In the form of EMIs. In bits and pieces in the form of installments. So bank when it gives, it will give 1 crore loan. But when it collect that 1 crore, it will collect over 20 years. Means my 100 rupees is going out now, 2 rupees only will come in another 1 year. Then how the banks are surviving? First, that question you should get in life. You are not getting that means you are not understanding it. Understood the logic clearly? Yeah. Hey, simple logic here. Banks are giving 100 rupees, but get back the EMIs in bits and pieces in installment. Then how banks are surviving? Listen, how it will survive. So banks and financial institution faces liquidity crunch. Okay, wants to get back their liquidity. To overcome this problem, bank will sell their assets. Which asset? Not bench, table, AC, not that asset. Loan given is a receivable for them. Those assets they will sell. Okay, but problem is I can sell this remote. I can sell this phone because there is a market. Where to sell this vegetable market? Phone will be sold in gadgets market. Mic will can be sold in gadgets market. iPad can be sold in a gadgets market. Buildings can be sold in real estate market. Like that, for every product, there is a market in India. Okay, throughout world as well. But I wanted to sell the loan. Who will buy the loan? Yeah, to sell, first there should be a buyer. Buyers and sellers meet at a place called as a market. Where is the market to buy this? That's how securitization market came into existence. That secondary market, securitization rise in India. See what will happen. Mechanism of debt securitization. Okay, listen. Bank or see the sequence properly. Bank or financial institution, also called as originator, gives loans or financial assistance to the borrowers, also called as obligor. Okay, now what will happen? Borrowers, okay, bank will give loans to borrowers. Okay, now these people may pay, may not pay. Sir, let us say for example they are paying, but problem is bank is giving loans to borrowers. Lot of money is blocked with the bank or not. What bank will do? Bank will conduct an auction. Bank will conduct an auction. It will tell, I will sell my loans. Then bank will tell that we are going to sell our loans. Whoever wanted to buy, you come and buy. Then a person will come called as SPV, Special Purpose Vehicle, also called as Asset Reconstruction Company. So SPV will be coming. This SPV will tell, hey, how many loans are there with you? He will tell 1,000 crore loans are there. Then I will buy. Who will buy? I will buy. SPV will buy. Okay, you will buy. Yes, I will buy. From where you will get the money? Listen carefully. Who is giving? Bank is giving. What it is giving? It is transferring the financial assets called as loans. To whom? To SPV. On in what intervals? Dependent. Sometimes banks will give in 1 year, 2 years interval or 6 months interval also. They will pool, package all kinds of loans into one set and they will sell. 1,000 crores worth of financial assets they sold. Okay, 1,000 crores is the principal amount. On this principal, they will collect almost again another 2,000 crores of interest. For all those present value, they will calculate. Say it came to 2,100 crore. 2,100 crore it came. See here. Bank gave financial assistance to borrower. Okay. Immediately, borrower has taken 1,000 crore loan, bank loses 1,000 crore liquidity. I want to get my liquidity back. How to get liquidity back? Sell them. See, I have 100 rupees in my pocket. Say I have 100 rupees in my pocket. I purchase this remote. Okay, I want my 100 back. What to do? Sell this remote. Same. Bank has 100 rupees in its pocket. Bank gave it as a loan. Loan document came, money went out. I want my money back. What to do? Sell this loan. To whom? To securitized assets. To the securitization market, you have to sell. That person is called as special purpose vehicle. These people will buy the debt securitized assets. Okay. So rights of financial assets will be transferred to SPV. To whom? SPV. Now listen carefully. Bank will pool, combine so many loans, packages, and transfer financial assets, not fixed assets. Okay, to whom? To SPV and ARC. To SPV or ARC. Now question, sir, bank itself got a problem. If we get a finance problem, we go to bank. If bank itself got a problem, where we have to go? Then comes into the picture the heroes in this particular area, QIBs, qualified institutional buyers. Who are they? Pension funds, insurance funds, mutual funds, banks, foreign institutional investors, FDIs. So many people are there throughout the globe who are having money, but they don't know where to invest. Okay, where to invest, they don't know. Mutual fund companies will be there. Na? What they have to do, lot of money will come. Somewhere they have to put their money. Na? There they will invest. Sir, this is risky. Little risk, but it's a loan. Na? Listen carefully what will happen. Please listen. Who gave loan? Bank. Which loans? Secured loans they have given. Means there is a asset security for that. There is a asset security. So these are secured assets. These are secured assets. So what will happen? These QIBs will be there na market. These QIBs are there na. These QIBs will give that 2,100 crore. Okay. Sir, how they will give? What they will take in return? This SPV will give pass-through certificate. Pass-through certificate. It's called as a debenture type or security receipts. Security receipts. So vehicle loans, general corporate loans, housing loans like that, they will give security receipts. Listen carefully. Bank gave loan, money went out of bank, bank will sell to these people. These people have to pay 2,100. From where they will get? If I get a problem, I will go to God. God himself got a problem, means where he will go? Like that only situation. Bank will help us. Bank ke problem came. Who will come? Then people have to come. Okay. Who are those people? QIB. QIB will give the 2,100 crore to ARC or SPV. SPV will in return give them bonds, debentures they will give worth 2,100 crore. Worth 2,100 crore. Subscribe to these mortgage backed securities in the nature of debt. Sir, you said debentures. They are using the word mortgage backed security. Mortgage backed security means they are not normal debentures. They are secured debentures. A security they call mortgage. Security backed securities. Means what? See, SPV will take money from investors. That investors can't take risk. Therefore, what they will ask? Array SPV, you are buying 2,100 crores worth loans. Yes, those are all secured, unsecured, secured. Do one thing. That security amount is there. Na? You also keep for these bonds. Okay. If you don't pay us interest and other things, na, we will sell that security. So every month in this 1,000 crore principal, EMIs are collected. So borrowers will pay EMI collected by a separate person called as servicer. What is it? Servicer. Servicer will collect the EMIs. Gunda batch. These people will collect the EMI. In this EMI, two parts are there. Interest part, principal part. Interest part on this EMI will be used to pay interest on the bonds issued to the QIBs. Principal part will be used to pay them the principal amount. This is how securitization actually works. This is debt securitization concept. See, origination function. That's why we call him originator. Kaushik Mukesh, if he tells now one word also should not go outside here. Logic is the key, not mucking up of concepts like a nonsense idiots. So please, always we have to understand one important thing here. When concept, when it comes, you should be the king in that. Are you understanding or not? A normal fool will read without having any logic. We are not idiots like that. We have common sense. First, we need to understand what is this originator function. Borrower seeks loan from a finance company like HDFC. Yes, borrower seek finance. The credit worthiness of borrower is evaluated. Contract is entered into with the repayment schedule. Okay. Pooling function. Pooling function. Packaging and transferring. Similar loans or receivables are clubbed together. 1,000 crores they will club. Okay. Underlying pool of assets. It will be transferred in favor of SPV, who act as a trustee for the investors. Investors. Securitization function. SPV will structure and issue securities on the basis of asset pool. SPV issue securities on the basis of asset pool. On the basis of the 2,100 crore assets is there na, on the or 1,000 crore of loan amount. On that basis, they will create securities. Next. Securities carry coupon and maturity. Principal and interest, coupon and maturity. These are generally sold to investors through merchant bankers. Investors are pension fund, mutual fund, insurance fund, as it is what I said. The process of securitization is generally carried out without recourse. Means once securitization company, SPV taken bought the assets, that's all. Risk of recollecting the EMIs is entirely your headache. Non-recourse means you can't give back again. Okay. So these are the main points that you need to understand here. Okay. So most important point, debt securitization also completed with full clarity. Advantages of debt securitization. Asset is shifting off the balance sheet. Asset is shifted off the balance sheet. Means in the balance sheet you will not see anything. Rights are transferred. Previously bank is the owner. Now another person is the owner. That's all. It's a off balance sheet item. Thus originator recourse of the balance sheet funding. Recourse of the balance sheet funding. Means technically we are not taking any loan. We are not taking any loan. See, balance sheet like this it is. Correct? See here now. Previously receivable 100,000 crore. Okay, previously receivable 1,000 crore. Now what happened? These receivables are converted into cash. 2,100 crore. Did I take any loan from anyone? No. Just the balance sheet like excess money is created. That's why banks always call all of us over phone and torture us. Do you want credit card? Do you want housing loan? Why they will ask? Today they are giving 1,000 crore. 6 months they are getting back 2,100 crore risk free. That's the reason why always banks will kill us. Do you want credit card? Do you want any housing loan? Do you want any EMI? Do you want any personal loan? Why? If really bank is giving 100 crore and receiving back that 100 crore over 20 years, actually they should call us and ask a deposit. Never they will ask deposit. They will always ask for loan you want, loan you want, loan you want. Why? Because they gave 100 crores, 1,000 crores today. 8-9 months they are getting back 2,100 crores. Circulation is increased. It converts illiquid assets into liquid. Illiquid means what? Actually loan given means my money converted into receivable. Okay, we received over 20 years, liquidity is not there, immediate liquidity not there. Now we converted that into liquid funds. Facilitates better balance sheet management. Assets are transferred off balance sheet, facilitating satisfaction of capital adequacy norms. So immediately cash is generated, enough capital is created for banks. Okay, originator credit rating enhances. Originator credit rating enhances. Why credit rating enhances? There are no loans, there are no NPAs. All I sold to one person. Next one. Venture capital financing. Venture capital refers to capital investment made in a business or industrial enterprise which carries elements of risk and insecurity and the probability of business hazard. Sir, what is this? Venture capital means whenever a startup is going on, which kind of startup? It should be a business or industrial enterprise where there is a lot of risk and insecurity. Business can be a successful, business can be a failure. Many business hazards are there. Hazards mean difficulties. Those kind of businesses are getting, automobile business is there. Okay. Or you can observe now, battery manufacturing is now becoming one of the most booming business because of e-vehicles. So it is a risky venture because so many people are starting. There is insecurity. If government bans are gone. So those kind of ventures, generally banks will not come forward to give loans. Capital investment may assume the form of either equity or debt or both. Next, the risk associated with enterprise could be so high as to entail total loss or be so insignificant as to lead to high gains. Means, in simple, he wanted to tell only one point. What is that? The logic is very simple. Sometimes capital refers to capital investment in a new venture, new business, or a new industrial enterprise is always involving with lot of risk and insecurity. Probability of business hazards are very high. Point number one. Okay. Point number one. You can raise money either through equity or a debt or even through a derivative instrument also. No problem. Combination also you can go. Also called as convertible debt. Means it is both equity as well as debt. You can also go with that. So capital can be invested either in the form of equity or in the form of debt or in the form of both. Okay. Risk is so high that you may get a loss or gain will come. Insignificant gain will come. Okay. Okay. European Venture Capital Association describes venture capital as risk finance for entrepreneurial growth oriented companies. It is an investment for medium or long term seeking to maximize the return. Generally, without going for the banks for such a high amount of risk is involved, banks don't give the loan. Venture capitalists will be there. Who will be there? Venture capitalists, billionaires, millionaires will be there. Those people, Warren Buffett, all these people do this. What they will do? They will venture the capital. Okay. So simply to tell, there is a venture. They will fund the capital. They know that it is very risky. Anyway, they have invested in so many companies now. They are ready to take that risk to get a higher return. Okay. Venture capital thus implies an investment in the form of equity for high risk projects with an expectation of higher. Just now I told you, high risk means high return also will come. The investments are made through private placement with exception of risk of total loss or huge return. High technology industry is more attractive to venture capital financing due to high profit potential. Those are the points you need to write. Everywhere same concept. Yeah, high risk projects will go for venture capital. It can be both equity, debt, or even combination of both. High risk associated enterprises will always be having venture capital. They may either give a loss or they will give insignificant gains. Where there is a high risk, there will be a high return. There will be a high return. So these are all some points you need to quote. Methods of venture financing. Methods of venture. Just now we told equity debt combination. We are going to read now. Equity. Venture capital undertakings generally require funds for long period, but may not be able to provide returns to investors during initial stages. So you will give. I will want for 15 years. You will give, but returns won't come immediately. Na? Therefore, the venture capital finance is generally provided by way of equity share capital. See, I will give. I can't give any return in next 10 years. I'll debentures general life at 10 years. 10 years you don't give any return means I have to give principal and take principal back after 10 years like a fool without having any ownership. Therefore, generally venture capital, initial 5-6 years profits won't come. Profits won't come. When profits won't come, there is a doubt also whether you pay interest or not. Therefore, they will generally go for equity share capital. Equity contribution of venture capital firm does not exceed 49% of the total. Means if 100 rupees is the total capital, venture financing should not go beyond 49%. Conditional loan. Conditional loan. Okay. Repayable in the form of royalty after the venture is able to generate the sales. Okay. That means they will give money as a conditional loan. As a conditional loan. It is repayable in the form of what? Royalty. For giving that help at the beginning stage. After the venture is able to generate the sale. Means they don't wait for profit. From the sales they will take royalty. Profit means sales minus all expenses. I don't wait. I will charge a royalty on the sales directly. No interest is paid on such loans. Why? I don't want your interest here. Interest comes below the sales. I want just 10% of sale. Give as a royalty to me. In India, venture capital finances charge royalty ranging between 2% to 15%. Actually, it depends on the venture. Cash flows, gestation period, etc. Some venture capital financiers give a choice to the enterprise of paying high rate of interest, which could be even 20% instead of royalty on sales. Sometimes they will also go for interest. See, royalty na 2% to 15% it will stop. But if you pay interest, they will ask high range, 20%, 24% they will ask instead of royalty on sales. See, until business is successful, profit may come, may not come, but sales will happen. Na? 10% you pay, 2 to 15%, 10% you pay. But commercially, company is successful. Conditional loan, na? Till I feel that company is not successful. Okay, pay interest on sales as a royalty. No interest is charged. Second, company becomes successful. Project is super hit. Huge sales happening. Okay, now it is better I will go for interest payment such that I can charge even 15-20% or even 25-30%. Income note. It is a hybrid security which combines conventional loan and conditional loan. Normal loan will be there in a bank loan, that one, and this conditional loan. The entrepreneur has to pay both interest and royalty on sales, but substantially low rates. IDBS venture capital funds provides funding equal to 80 to 87% of the project. Not interest. 100 rupees is the capital. I will give 80 to 87.5%. Let's say 85 rupees I have given. I will ask for royalty and also ask for interest, hybrid. That's called as income note. Participating debenture. Such security charges in carries charges in three phases. In startup, no interest is charged. In next stage, low interest. And last stage, when performance started, then high interest will be charged. Next, discuss the factors that venture capitalists should consider before financing any risky project. Okay, quality of management team, because they are going to use your money. Are you understanding? So high level of committed management team is required. Okay, high level of quality management is required. Next one, technical ability of the team is also vital. They should be able to develop and produce a new product or service. So technical ability of whom? Of the team. Next one, technical feasibility of the product. See whether a team is really having that much worth to create that product or not. I should see they will create the product, how that product has a saleability in the market. So technical feasibility of the new product. Since risk involved in investing is quite high, venture capitalists should ensure that prospects for future project compensate the risk, whether profit is compensating the risk or not. Okay, research must be carried out to ensure that there is a market for the new product. Actually, this point and this point both are same. First one is the feasibility of new product. Next one, research should be carried out whether there is a proper market or not. Okay, venture capitalist himself should have capacity to bear the risk if the project fails. So if the project fails, he should be in a position to bear the risk. So first one, quality management with high level of commitment. Second one will be talking about technical ability of the team. Next one, technical feasibility of the product. Next one, profit should balance with the risk. Next one, research will be carried out whether it is marketable or not. Next one, if the failure is there, venture capitalist should be able to absorb the loss on his own. Okay. So next, that's the main point here. These things you need to read. Next one, discuss seed capital assistance. The seed capital assistance has been designed by IDBI for professionally or technically qualified entrepreneurs. All the projects, see, IDBI has brought the seed capital assistance. All the projects eligible for financial assistance from IDBI through refinance are eligible under this scheme. So refinancing, they will be eligible. The project cost should not exceed, very, very important question here. Project cost should not exceed 2 crore. And the maximum loan that I will give is not exceeding 50% of promoter's contribution or 15 lakhs, whichever is lower. So promoters, if they give 100 crores, okay, I will not give 100 crores. Loan should not exceed 50% of promoter contribution or 15 lakhs, whichever is lower. Sir, what is seed capital assistance? Means promoters will give money to the company. Yes, sir. I will also give along with them, but I will not give huge amounts. IDBI started this concept of seed capital assistance for professionally and technically qualified entrepreneurs like IIT graduates, CAs, etc. Project is eligible for financial assistance from IDBI. Number 2. So it is brought by IDBI for qualified and professionally, technically qualified professionals or entrepreneurs. Number 2, it is a financial assistance given by IDBI. Number 3, conditions to be satisfied. Project cost should not exceed 2 crore and maximum assistance under the scheme is restricted to 50% of promoter's contribution of 15 lakhs, whichever is less. Seed capital assistance is interest free, but it carries a charge of 1% for the first 5 years. Okay, charge on what? Charge on the overall loan. I gave you 15 lakhs, 1% you give as a service charge. Okay, 3 things you have to remember here. Global depository receipts. Okay, global depository receipts means other countries can invest in our country's equity shares, not directly. They will issue receipts to a depository in India, and depository will issue them to issue the receipts to the public in India. Public has to convert those receipts into shares, then they will become the shareholders and they will get the dividend. If you do not understand what I said, go back, listen and come back again. Okay, so this is the main idea behind this. I don't want to discuss and waste my time. American depository receipts, the same concept. IDRs means Indian company is issuing the securities outside India. Are you understanding? GDR, IDR, there are two concepts or not? GDR la we will invest. IDR la other companies will issue in India. Other companies will issue in India. See, GDR, Global Deposit Receipts. Indian company wanted to raise outside India. What we will do, we will issue the shares to depository outside India. That depository will issue the receipts to public outside India. Those persons will buy receipts. They will convert into shares. They become shareholder of this company. Exact reverse it will happen na Indian depository receipts. Concept of depository receipt mechanism, which is used to raise funds in foreign currency, has been applied in Indian capital market through issue of IDR. Foreign companies can issue IDR, not Indian companies. Okay, Indian companies can issue GDRs and ADR. What is GDR, ADR? ADR means issue only in USA, America. Other places the GDRs will apply. Okay, IDRs are listed and traded in India. Bridge finance. Bridge finance. Okay, I will explain this. So let us understand what is the concept of a bridge finance. What is the concept of a bridge finance? See, bridge finance represents very simple. Yeah, we will go to a bank and ask for a 100 crore loan, but disbursement from the bank requires some time. Bank, you know, na, procedures are involved. But I can't wait till bank said that 21 days, so we will process everything. But I have to start the project in next 10 days. Therefore, what they will do, just to cater the needs of next 10-15 days, they will take loan from public. They will take loan from public, or they will take short-term loan from any other bank. That short-term loan, just to bridge the gap, bridge the finance taken, just to bridge the gap between date of sanction and date of actual disbursement, is called as a bridge finance. It is a short-term finance, and this financing will be there. Now I have taken, to start it, I require somewhere around 8 crores out of 100 crores. That 8 crores only I will take as a short-term loan for 15 days. Loan will be coming now 100 crores. Immediately out of that loan only I will pay that 8 crores. Bridge finance refers normally to loans taken by businesses. Important question. Usually from commercial banks for a short period, pending disbursement of term loans. Means what? I will take from commercial banks. Why? Disbursement is pending for the term loan. Normally it takes time for financial institution to finalize the procedures of creation of security. There is a lot of procedures involved. So though positively they appraised, means what? Bank said we will give loan, but it will take 30 days time. I can't wait. Another 5 days I have to start. So for the next 25 days till loan is given, I will take another small loan for bridging the gap. However, once the loans are approved in principle, firms, in order not to lose further time in starting their project, arrange a bridge finance. So loan is approved in principle, means in documentation approved, but it will take 25-30 days because it's a 100 crore amount. Such a temporary loan is normally repaid out of proceeds of the principal term loans. Once the loan is given, immediately they will pay. It is secured by hypothecation of mobile assets, etc. Those 25 days money is also secured. Generally, rate of interest on bridge financing higher than compared to term loans. Obvious that for 25 days only you are giving 18%, 19% they will charge. But okay, no problem. Okay, that's the concept here. These are all some important questions. Okay, another 30 minutes video I will make covering out all other important concepts in theory, such that you will become ultimately perfect in this particular area. Okay, thank you, and don't miss to watch yesterday's live. Modiglani Miller versus Modiglani Miller, two concepts I have done, very important. Be careful.